with ABM, we're getting the report on financial management. At the first place definition discussed by Mike Ponta, theories discussed by Joshua Mendoza, scope and elements discussed by Mar Navarro, objectives and function discussed by Maria Brosas and Gian Cahigal, role of financial managers discussed by Andres Fajidos, importance discussed by Jinwei Salazar. Let's start with the definition.
Definitions of financial and management. From the word financial is a term for matters regarding the management, creation, and study of money and investment. Specifically, it deals with the question of how and why an individual, company, or government acquires the money needed, called capital in the company context, and how they spend or invest that money. For financial, we all know it is all about money and investment, like company that engage in any financial dealings. Could be terms of money used by entrepreneurs and business to buy what they need to make their products or to provide their services. Examples of provider loans, credit, institution, or savings. From the word management, management is the coordination and administration of tasks to achieve a goal. Such administration activities include setting organizations, strategy, and coordinating the efforts of staff to accomplish these objectives through the application of available resources. For management or general management policy is all about guidance. Consider the enhance of a between relationship and provide guidance on the process of implementing, managing, monitoring, and reviewing clients' investment.
Now, let's talk about financial theory. There are a lot of theory in financial management. Okay, the first one is some expert believes that financial management is all about providing funds needed by a business on terms that are most favorable, keeping its objective in mind. Another set of expert believes that finance is all about cash. The third one, and more widely accepted point of view, is that financial management includes the procurement of funds and their effective utilization. Therefore, this approach concerns primarily with the procurement of funds, which may include instrument, institution, and practices to raise funds. It also takes care of the legal and accounting relationship between an enterprise and its source of fund. Since all business transactions involve cash, indirectly or directly, finance is concerned with everything done by for the business. For example, in case of the manufacturing company, financial management must ensure that funds are available for installing the production, plant, and machinery. Furthermore, it must also ensure that the profits adequately compensate the costs and risks borne by the business. There are a lot of theory. Some of them are agency theory, expectation theory, liquidity preference theory, market segmentation theory, preferred habitat theory, modern portfolio theory, arbitrage pricing theory, and so on and so forth.
Scope elements. Investment decision includes investment in fixed assets. It is called as capital budgeting. Investment in current assets are also a part of investment decisions called as working capital decision. Long-term investment decision and capital budgeting. Budgeting means committing funds for a long period of time like fixed assets. These decisions are irreversible and usually includes the ones pertaining to invest in a building and or land, acquiring new plants, machinery, or replacing the old ones, etc. These decisions determine the financial pursuits and performance of a business. Short-term investment decision or working capital management means committing funds for a short period of time like current assets. This involves decision pertaining to the investment of funds in the inventory, cash, bank, deposits, and other short-term investments. They directly affect the liquidity and performance of the business. Financial decision. They relate to the raising of finance from various resources which will depend upon decision on type of source, period of financing, cost of financing, and returns thereby. Financial planning decision, which relate to estimating the sources and application of funds. It means pre-estimating financial needs of an organization to ensure the availability of adequate finance. The primary objective of financial planning is to plan and ensure that the funds are available as and when required. Capital structure decision, which involves identifying sources of funds. They also involve decisions with respect to choosing external sources like issuing shares, bonds, borrowing from the bank, or internal sources like retained earnings for raising funds. Dividend decision. This involves decisions related to the portion of profits that will be distributed as dividend. Shareholders always demand a higher dividend, while the management would want to retain profit for business needs. Dividend for shareholders. Dividend and the rate of it has to be decided. Retained profits. Amount of retained profits has to be finalized, which will depend upon expansion and diversification plans of the enterprise. The scope of financial management. Financial management, financing decision, investment decision, dividend decision.
Objectives of financial management. Number 1. To ensure regular and adequate supply of funds to the concern. This is to make sure that there is enough and regular fund to pay for all the things needed to be paid. Number 2. To ensure adequate returns to the shareholders, which will depend upon the earning capacity, marketplace of the share, expectations of the shareholders. This is to ensure the shareholders that they will be receiving profit shares depending on the sales and based on the market price and what they ought to receive. Number 3. To ensure optimum funds utilization. Once the funds are procured, they should be utilized in maximum possible way at least cost. This is to make sure that there is proper utilization of funds once on hand. Number 4. To ensure safety on investment. Funds should be invested in safe ventures so that adequate rate of return can be achieved. This is to make sure that the funds are safely kept or used. Safe funds will be used to create investment on other companies. Guaranteed return must be achieved. Number 5. To plan a sound capital structure. There should be sound and fair composition of capital so that a balance is maintained between debt and equity capital. There should be a good structure of the capital. Balance of debt and equity capital must be achieved.
Taking charge of the company's financial policies and strategies, investment, capital structure, and dividend policies. Financial managers of organization must formulate sound financial standing plans that communicate broad guidelines for their financial decisions and strategies. These plans include typical financial policies that address the organization's investments, capital structure, and dividend policies. They have to formulate sound financial standing plans, and these plans includes investments or the total assets or long-term assets. But they need money. For this, that's why they have to finance decisions to raise money, or the debt and the equity financing. And that is called capital structure decisions. S19. Financial management and control. The management and custody of the organization's fund are also include controls, which gives an assurance that funds are properly utilized in order to provide for all the organization's needs. project management, or the project goals they need to achieve within the given constraints. And the second one is working capital management, help companies effectively make use of current assets and helping companies to maintain sufficient cash flows. And the third one in cash management, process of collecting and managing cash flow. And the fourth, account and the receivable management, process of ensuring company account and receivable management, process of ensuring company pay their dues on time. And the fifth one is inventory management, the right stocks, the right level, in the right place at the right time, and the right cost. And the sixth one is the fund sources management, ensures maturity schedules. Dividend policy management are paid out of profits. Financial planning. This includes financial forecasting, financial analysis, and financial performance evaluation. Financial forecasting involves cash budgeting, profit planning, and balance sheet forecasting. The example of it is the company's sales can help support the goals. And the next one is financial analysis. It involves capital budgeting techniques, operating leverage analysis, financial leverage analysis, and analysis of pricing and cost. It analyzes companies' performance and trend by calculating financial ratios. And the third one is financial performance evaluation refers to assessment of financial ratios to indicate the overall performance of the organization, as well as the assessment of market-wide financial indicators. And the example of it is gross profit margin, net profit margin, and working capital.